This is a story of how a single day reshaped the economy of an entire nation. It's a story of a battle, not a battle of armies or ideologies, but a battle between centuries of tradition and a single unthinkable idea. On one side, the Bank of England, nearly 300 years of reputation, the guardian of the pound sterling, the currency that once ruled the world. On the other, George Soros, a financier, an immigrant, a philosopher, a man who didn't just play the markets, he tried to understand their soul. On September 16, 1992, these two forces collided. By sunset, one lay in ruins, and the other had become known as the man who broke the Bank of England. He made $1 billion. The British taxpayer lost more than $3 billion. This is the story of Black Wednesday. To understand how David could defeat Goliath, we have to go back to 1979. After a decade of oil shocks and the chaos following the collapse of the Bretton Woods system, Europe was desperate for stability. And so, the European monetary system was born, and at its heart the exchange rate mechanism, or ERM. Its predecessor was nicknamed the Snake in the Tunnel, but the ERM was a far more serious project. It was an agreement, a club, designed to bind Europe's currencies together. The goal was ambitious, to pave the way for a future single currency, the euro. The system was simple but rigid. Each currency was given a central rate against the others, but the unofficial anchor, the gold standard of the system, was one currency, the German Deutsche Mark. Germany's economy was Europe's locomotive, and its central bank, the Bundesbank, had an ironclad reputation for fighting inflation. Everyone else had to follow. Member countries pledged to keep their currencies from fluctuating more than a narrow band, usually plus or minus 2.25%. If a currency weakened, its central bank had to either raise interest rates or spend its reserves, buying its own currency. For the United Kingdom, watching from across the Channel, this looked like a trap. Prime Minister Margaret Thatcher, a famous Eurosceptic, resisted for years. She saw the ERM as an assault on British sovereignty, a transfer of economic control to bankers in Frankfurt. But by 1990, the pressure was unbearable. British inflation was high. The Berlin Wall had fallen, and German reunification was making the German economy even more dominant. The Chancellor, John Major, convinced Thatcher that the ERM was a silver bullet to fight British inflation. In October 1990, Britain surrendered. It joined the ERM, but it did so with a fatal flaw. The pound was pegged to the Deutsche Mark at a rate of 2.95, a rate that was far too high. It was a number dictated by political prestige, not economic reality. Even the government's own advisers warned it would make British exports uncompetitive and strangle the economy. The British economy, already entering a recession, was now in golden handcuffs. It needed low interest rates and a cheap currency to stimulate exports. Instead, it was chained to the strongest currency in Europe at the worst possible time. The Bank of England was given its orders: defend the 2.95 rate at all costs. If the pound started to fall, the bank had to intervene, spend its precious foreign currency reserves to buy pounds and artificially prop up the price. For 2 years, the bank fought this grueling war. It bought pounds again and again. It held the line. But in financial markets, there are no secrets. Everyone could see Britain was trapped. Everyone could see its economy was weak and its currency was overvalued. Everyone was waiting for the Colossus to fall, but no one dared to strike the first blow. The catalyst that turned this fundamental crack into a chasm came from Berlin. German reunification in 1990 was a political triumph, but an economic time bomb. Billions of Deutsche Marks flooded east to rebuild the former GDR. For the German central bank, the Bundesbank, this was an existential challenge. The horror of Weimar-era hyperinflation was seared into their DNA, their national memory. They had one mandate: price stability, at any cost, and they did the only thing they knew how to do in the face of inflationary pressure. They raised interest rates, again and again. This made the Deutsche Mark, the anchor of the entire ERM system, incredibly strong and expensive. And for Britain, chained to that anchor, it was a catastrophe. To keep the pound tethered, Britain had to either match German rates, killing its already weak economy, or spend billions in reserves to hold the peg. They chose the latter. The Bank of England was bleeding out just to stay in place. And in New York, someone noticed. There, far from the old traditions of the City of London, a man was watching who saw the world differently. George Soros. A Hungarian immigrant, a survivor of the war, he was not just a financier. He was a student of the philosopher Karl Popper. Along with his chief strategist, a young prodigy named Stanley Druckenmiller, he ran the Quantum Fund. And Soros had a theory that made him an incredibly dangerous opponent. He called it the theory of reflexivity. Classical economics says that markets are a passive thermometer. They just reflect reality, a company's profits, an economy's strength, a crop yield. Soros believed this was wrong. He argued that markets are an active engine. In his theory, the perceptions of investors, their fears, their greed, their biases, are not just noise. They are an active force that shapes reality itself. If enough people believe an asset is overvalued, they will sell it. This forces the price down, which validates their original belief and causes more people to sell. Perception becomes reality. It's a self-fulfilling prophecy, a feedback loop. This was a radical idea. But today we live in a world built entirely on it. A world where a single tweet can create or destroy billions, where meme stocks can soar in defiance of fundamentals, where belief and narrative are often a more valuable commodity than profit. Soros understood this decades early. In the fall of 1992, Soros and Druckenmiller saw the Bank of England trapped in a perfect reflexive loop. The reality was that the British economy was weak and needed a cheap pound. The government's perception was that the pound must be strong for political prestige. The Bank of England was spending billions to defend the perception while ignoring the reality. Soros realized that as soon as the markets saw this lie, the panic would be total. He wasn't going to create the pound's weakness. He was going to bet that gravity, in the end, always wins. On the evening of September 15th, 1992, Soros looked at Druckenmiller's position. He was already risking hundreds of millions. But Soros didn't see risk. He saw inevitability. As Druckenmiller later recalled, Soros's contribution was to push me to take a gigantic position. Soros looked at his trader and said the line that became legend, "It's time to go for the jugular." The Quantum Fund increased its bet against the pound to $10 billion. It wasn't just a trade, it was a signal, a challenge thrown down to the Bank of England, the morning of September 16th, 1992. Black Wednesday. As trading opened in London, all hell broke loose. Seeing Soros's massive bet, traders around the world knew the game was up. Everyone who held pounds rushed to sell them. It was an avalanche. The Bank of England was under siege. In a panic, officials followed the protocol. First line of defence, spend the reserves. The bank began buying pounds, billion after billion. By some estimates, they were spending over £2 billion per hour. But it was like trying to stop a tsunami with a bucket. The market was too big. Second line of defence, desperation. At 11 Hawag AM, the government announced it was raising its base interest rate from 10% to 12%. This was a shock. In the middle of a recession, raising rates was economic suicide. They were hoping to attract capital with high returns. The market paused for a moment and then laughed. The traders didn't see strength, they saw panic. They kept selling. Third line of defence, insanity. Just a few hours later, the government announced a second rate hike that day, to 15%. It was a shot in the dark, but by then no one was listening. By evening, the Bank of England was broken. It had spent, by various estimates, up to £27 billion of its foreign currency reserves. Everything it had. And it accomplished nothing. At 7:30 p.m, an exhausted Chancellor, Norman Lamont, stepped in front of the press and announced, the United Kingdom was withdrawing from the exchange rate mechanism. The pound would be allowed to fall. Curtain. Soros's bet paid off. In a single day, the Quantum Fund had made over $1 billion. The British Treasury, after counting the cost of its futile defence, would later estimate its net loss at £3.3 billion. The reputation of the Bank of England, the old lady of Threadneedle Street, was shattered. After the battle, Soros's team went quiet. As one of the traders later recalled, "We were told, avoid cocktail parties, no bow ties, just lay low." They knew what they had just done. But what had they done? Here the story takes its greatest ironic turn. The day that went down in history as Black Wednesday, a day of political shame for Britain, turned out to be the salvation of its economy. In hindsight, many economists call it Golden Wednesday. What did Soros do? He used force to make the British government do what it should have done itself, but was too afraid to because of political prestige. Freed from the ERM, the pound immediately crashed to its natural lower level. Suddenly, British goods were cheap and competitive on the world market. Exports soared. More importantly, now that the Bank of England was released from the golden handcuffs of the ERM, it could finally do what the economy needed: slash interest rates. From that emergency high of 15%, they were cut down to 6% within months. For a country suffocating in recession, it was a breath of fresh air. It kicked off one of the longest periods of uninterrupted economic growth in modern British history. George Soros became the symbol of the ruthless speculator. To many, he is a villain who profits from misery. But his own analysis was colder. He did not create the pound's weakness. He exposed it. He did not invent the flaw in the ERM. He exploited it. His theory of reflexivity was proven on the grandest possible scale. The Bank of England believed reality was a fixed exchange rate. Soros understood that reality is what the market believes. And he placed a bet that changed the market's belief. Black Wednesday was not just a financial transaction, it was a lesson. A lesson that in the modern world of global finance, no tradition and no central bank can defy economic gravity forever. Today, we live in the world Soros and Druckenmiller helped create. A world where trillions of dollars in capital can move across the planet at the click of a button. Where investor belief can build an empire or shatter it in a single day. The story of Black Wednesday is a reminder that markets are not just machines. They are arenas of human psychology. And sometimes, to win, you don't just have to calculate the numbers. You have to know when it's time to go for the jugular.